Yeah, so my name's Matt Joass, Chief Investment Officer at Maven Funds. I'll try and keep the intro part brief so we can get stuck into the stock that we're going to talk about. Originally from New Zealand, grew up very interested in investing from an early age, but didn't really have like a framework to hang it on until I discovered Buffett, like a lot of people, in my early 20s. Kind of took over my life then. At the time, I was living in Copenhagen, Denmark. Joined a grad program for a big shipping company. Very clear kind of career path ahead, but investing kind of took over my nights and weekends during a long, cold Danish winter, and realized it was time to kind of make it a full-time career. Around that time, I also discovered Motley Fool and their style of growth investing. And that kind of it sets the stage for, I guess, the approach that we take at Maven. And my preferred approach is this merger between these two ideas of value and growth and high optionality growth investing. I know David's presented at this conference before, big influence for me. And another gentleman, Joe Mager, who's presented here before. I moved down to Australia, left that safe career to join the Motley Fool and work on a portfolio service with Joe called Motley Fool Pro. Just focused on Australia and New Zealand small cap companies that have we thought had the ability to grow to be very large. We were fortunate enough to identify a few businesses that went on to become kind of darlings in the market, tech businesses like Xero, WiseTech, Altium, etc. And then I left there a little over 2 years ago, kind of thinking I'd manage my own money, do something just with friends and family. But we had a lot of those former clients reach out. People had some good returns, and it was just, I guess, quite motivating to me. A lot of folks who were able to give back to their communities. One gentleman wanted to start a charity with some of the other investors. Someone else was building houses and developing countries. And yeah, I guess it was a big motivator for me, is kind of helping people with investing. So that's what led to the launch of Maven just over 2 years ago. So Maven, why the name Maven? A big part of our focus, I've heard at a few presentations I tuned into today, is finding what we'd call a fundamental inflection point. But basically a business whose fundamental cash flows are going to be radically different in the future than they have been in the past. Can be a few different reasons for that. The one we'll talk about today is when there's a segment of the business that's growing much faster than the existing business. So over time, it's kind of hidden to begin with, but over time, as it rises, it dominates the whole business. And the name Maven comes from the book The Tipping Point by Malcolm Gladwell, where he described these certain people who are able to identify trends early. They're kind of like a trusted expert, watches everything that's going on, and then communicates what they see to other people at that tipping point. That's what we're trying to do. Our approach, we call it finding monsters, but it's essentially trying to identify companies we think have the ability or potential to become multi-baggers, but aren't, I guess, not just getting there, being lucky. So in Australia in particular, there's a lot of speculative mining companies. Literally half of the index by number of companies would be those. We're not trying to find those. We're trying to find businesses we think have something that you can value and something that's repeatable. I'll come on that again in a second. Our motto comes from Thomas Phelps' book, 100 to 1 in the Stock Market, where he says that to be successful in the market, you must have the vision to see, the courage to buy, and the patience to hold, which I quite liked. So again, our approach, like a lot of folks, are trying to find these few businesses. Thomas Phelps' book talked about a few traits they all have. We call them monsters, kind of an homage to Monster Beverage, which was well over a 2,000-fold return. So 10 grand becomes over 20 million, even more than that today. And what we like again about it is that it's something that you could have foreseen at the time. It's very easy to look back at a biotech or something that's really speculative, and I don't think I could have predicted that, but we're trying to build a process around it. So part of the traits that he found in that book, that study from the 1970s of businesses that had these big outcomes, start out small, they have a unique edge, superior management, and they're misunderstood at the beginning, which helps with multiples. And just to tie it together, I guess the style that a lot of us are talking about has become more popular over the last few years. If I think back to 2021, it felt like everyone was looking for these big growth companies. But I think a lot of people had made the mistake of a bull market and quote unquote learned to ignore valuation. And I guess our approach is we're always trying to bring it back to valuation. I think the kind of oversight with traditional value investing is thinking of it as a static exercise. So I like the analogy of a tree. Like imagine we've got a 6-foot tall tree standing here. The kind of traditional approach would look at that and say, there's not that much timber on the tree. What could we make, like a baseball bat out of it or something? It's not worth that much. But if you look at that business or that tree is a living organism, we think businesses are more like living organisms in a dynamic environment, then you should be thinking about the future. And that's what we're trying to do, is trying to understand the kind of ecosystem, the complex adaptive environment that the business operates in, and then identify those that have a much brighter future ahead and bringing it back to valuation and time together. So without further ado, let me jump into the company we're going to talk through today. Very Australian company, I thought fitting for our focus is Australia and New Zealand. Australian listed, ticker is MAD, Mader Group. A bit under 400 million USD equivalent market cap. I think it's an underfollowed compounder. It's been compounding at over 30% a year for a long time since its inception. It's replicating a proven business model innovation. It's got very high insider ownership, including the founder who owns over half the company. We think at least 33% upside to fair value based on our estimates, and as I'll get to, I think that it could even beat that. And some big global tailwinds. I'm sure a few others are presenting at this conference about what's going on in energy and mining, that there is this potential for a shortage. There's really just a crucial shortage of labor in this market, and that's what Mader provides, which we'll get to in a sec. So again, before I get into the business, it ticks a lot of the boxes. These are kind of like our ideal list, and typically a very good opportunity will hold some of these. It's very rare to find something which has all of them. I won't go through all of them right now, but just the highlights. Very aligned, competent leaders, high returns on incremental investment capital, strong unit economics, demand and supply side competitive advantages, misunderstood, we'll get that to that in a sec, tipping past a fundamental inflection point, the high growth new verticals, and most importantly, is undervalued. And I should just say, first mover in an emerging and important industry. That comes directly from David Gardner, one of his 6 traits that he looks for. And I believe that, at least with this business model that Mader's pursuing, they're a first mover. So what does Mader do? Maybe go back to the beginning. It was only 17 years ago that it was launched in 2005. Luke Mader, the founder, was working in the Pilbara, which, if you don't know Western Australia, it's hot, dusty, very dry, very remote. Nobody's around. He's sitting out there, probably leaning up against one of these huge tires, twice as big as a man. He's working as a mechanic, working on this equipment. So he was working for one of what we call the OEMs, the original equipment manufacturers. Think like Caterpillar, who make this big, heavy mining equipment. And he was one of the service people. So for these mining companies, they make most of their money selling the equipment. And then they make a lot of money, very high margin money, on the spare parts. But the services part, they had really been neglecting. Because it was the default option for a lot of people, they didn't think about it, they just went to that provider. It meant that they took it for granted, essentially. And what he saw, he was working for them, and he basically saw they had a very sweet gig. They charged a lot to clients, they're very slow to respond, they were difficult to work with, they'd never work on any equipment that wasn't their own, and didn't pay their workers that well, even though these are very highly skilled workers. It'd be very common for a diesel mechanic in the Pilbara to be earning $200,000 a year. And it's the recipe right for disruption as he saw it. So that was Luke's opportunity to enter the market and disrupt what was going on. So what Mader provides is a workforce of mechanics, started out with diesel mechanics. It sounds kind of boring. Again, we'll get into why I think it's so interesting. These are really critical pieces of machinery. If a machine's offline for a few days, it can be hundreds of millions or billions of dollars of the revenue, depending on how long it's down, that is lost. So it's really critical that they have high uptime. And this is a kind of mission critical service that they're providing. It's also tied to production, not exploration. So it's quite different, as we'll get to other mining services businesses. This is what the virtuous cycle I think Mader's been on. He started out, Luke, just himself recruiting some of his mates. They recruited their mates, and they focused on just getting the best mechanics that they could find. Because of that, they developed a reputation for quality, and they were able to win more mine sites. With that, they're also able to launch new verticals, that we'll touch on in a minute, get higher margins. And this is a really key point of their model: increase utilization. Traditionally, in this industry, it's common to have 70 to 80% utilization of labor. Mader works on 95 to 100, and they're disappointed if it's below 97. So really high utilization. And that means more flexibility for those workers and higher staff take-home pay, even if the hourly rate's a bit lower, basically because they're working more, so they get more at the end of each fortnightly cycle. That all makes it a great place to work. Mader's won numerous awards for being a great place to work. And that's really a key for the linchpin in all this is recruiting top talent. One of the things that Maven does differently is moves people around a lot. That flexibility, the more sites you're on, means that you can move people around. These guys hate getting stuck at some boring, dusty mine site with nothing to do. They want to move around. They want to see a bit more of the world, and that's Maven now with particularly international opportunities. The US and Canada can do that. So that basically, Maven is a business model innovation. We talk a lot about tech disruption. Maven is a business model disruption. They're disrupting the original equipment manufacturers on this side, who are way overcharging, offering a better service, made us cheaper and faster. And then on this other side, kind of the small operators that Maven grew out of, they might try and undercut Maven on price, but they're just not able to be as reliable. As we'll hear in a minute, if someone calls Maven to get a job done, they know that they can get a mechanic on site very quickly, get a high quality service, and it's got a really strong culture underpinning that. So Maven today, from 17 years ago, it's now run rating at just under 500 million in revenue. These are all Aussie dollars. It's got over 2,200 staff. Just over the last 5 years, it's been CAGR revenue at 30%, it's even higher. Before then, they're guiding for another 23% plus year of growth revenue. It's very early in the year. It's the financial year here ends in June next year. And Maven has a history of upgrading and beating its guidance. So I think they've got a good shot at doing that, a very good shot at doing that this year as well, if everything continues. Aligned and competent management. So Luke Mader, the founder and still an executive director, is very crucial to growth in the business, owns over half the company. Another director owns about 19%. So insiders together have over 75% of shares. And the CEO, Justin Ewich, is a very competent CEO. Luke brought in a professional CEO to manage the scale as it grew to be a very large business, but he's very incentivized to grow net profits with targets around FY24, 40 million and 60 million in 26. And we think that's quite achievable. If there was two words to sum up the Maven thesis, I think it would be the scaled repetition. If you think of the best businesses or the best compounders over time, typically what they're doing is they're finding a formula that works, and then they're scaling that up to larger and larger markets. So Coca-Cola, right? They found a secret magical formula that you can drink as much of as you want and you never get sick of it. Then they found a distribution formula that worked. That two together, they scaled that globally, state by state and globally. Same with Walmart. They find a shop model that works. They scale it out. Starbucks, there's a Starbucks in your Starbucks. I think that this scaled repetition is the key to a lot of this compounding and finding monsters. And what's interesting about Maven is they're scaling into larger markets because they started in Australia, where they're now very dominant. They're about 10 times bigger than the nearest competitor, but they're now scaling into North America, Canada, energy. They've got another international segment as well. These markets they're growing faster there, so over 100% revenue growth in North America. They're also a lot higher margin. So North American EBIT margins are almost double Australia's, around 18% versus say 9 to 10% in Australia. And in this chart, they're just outlining that they've replicated this model in many different markets around Australia and then now internationally. Maven talks about its growth drivers. So I think that we just highlight that there's a lot of different verticals that are now expanding this model into. They're trying to repeat this into. And we just put a green box around these top ones. North America, again, growing 100% there off a decent revenue base now. Maven Energy is very new. It's just been launched. Maven Canada just been launched this last year. It didn't have no real meaningful contribution to last year's numbers, but it seems like intense demand. Management have talked about it being the strongest vortex they've ever seen. And then infrastructure maintenance, that's going out to all their existing customers, think BHP, Rio, and recognizing it's not just the mobile, the big Tonga trucks that you guys drive around that we can work on. There's also all the fixed infrastructure that you have, which covers up a whole lot of different processing, machinery and transport, etc. And that's a different recruiting base, which is key because Maven, like a lot of this industry, is constrained by talent. So going into infrastructure maintenance, they can go out and target a new area to recruit. The bottom line is we think each of these top ones here have the ability to be larger than the current businesses today, some of them significantly larger. Then you've got other secondary growth drivers expanding into rail, ancillary, power and marine. We really think if Maven is able to maintain its culture, that it has a really good shot of entering its different markets. So a lot of what I talked about today, you could probably read from just digging into the business itself. So I thought I'd give a few nuggets from some of our deeper research. We talked to competitors, customers, former employees. This was when we asked someone what their thoughts were on the competitive landscape. This is a competitor to Meta. They said, I don't think it's a comparison to be fair. Meta are in a league of their own. They're far, far above. They've got a huge reach. With money, they have the ability to have marketing departments, so they're advertising everywhere. Another quote, I think everyone knows that Meta is the go-to because they're always able to get people out onto your site. And this is another competitor who's one of those smaller competitors trying to compete, talking about how Meta, that this competitor can pay those employees more. But if they were purely taking the money, they would go work for these smaller contractors. One of the things about being a mechanic is that you can't really stay in one place for too long. And that's one of the biggest issues guys don't like to work for the big miners. You're stuck in one mine site. You're stuck with the same supervisor. If you don't get along, you're in trouble. Unfortunately, it's too bad. Whereas being a contractor with Meta, you have the ability from one day to the next to go to a different mine site. And now they have the ability to recruit internationally to Canada. A lot of their employees are young guys, very talented, and they want to move around. They also send some folks over to Africa and train people up. It's a very dynamic business. So we think it's got some important moats. That trusted quality reputation is really key. That's what the business has been founded on, and it's important that that is maintained. A really strong culture. Cultural moats are very fuzzy, but I think they're incredibly powerful, and they don't fit in a spreadsheet, so they're so easy to overlook. I think of something like Chick-fil-A as my quintessential cultural moat. Why is that business so successful? It's not even open one day of the week, but it's because of that intense culture. That's what we think is developing at Meta. And we think it's a really strong thing that ties the business together, makes the best people want to work for them. I think scale and utilization, as that kind of virtuous circle turns, they get more and more scale. That means they can respond to jobs faster. It means that they can utilize the staff more, because if there's ever any idle time, if you're a small shop, you have an idle guy, what do? They always have somewhere that they can send workers to. And they are able to invest and have better systems, admin, billing, recruitment. That sounds kind of obvious, but no other competitor that we've found has scaled past around 150 employees. I think it might be something to Dunbar's number of how many relationships you can manage, but basically the systems start getting really complex when you manage that many people. And you have to run this business really efficiently, and that's something that Meta does well. So what we think the market's getting wrong, kind of the same bias that we had when I first looked at the company. It's like mining services, who cares? These are typically really capital-intensive businesses, very cyclical, and very levered to exploration or construction phase, which if you think that you're about to have that can be a great trade, right? If you think we're about to have a lot of that boom. But for a multi-year potential multi-bagger, that isn't that attractive. What's different about Meta? So for one, it's tied to production, not exploration, and not investment. That means basically it benefits if there is a mining or energy boom from more production coming online, but then it stays at that level because it's tied to the maintenance and repair of equipment, not to the build out. We looked back at how 11 different publicly listed mining services companies in Australia handled the mining bust in 2014 to 16. It was really brutal. 4 of them went bankrupt, 7 that survived the downturn. Their revenue fell by 15%, and the rest swung to a net loss, 300% decline in net profit. But over that same period, Meta was able to keep growing revenue and keep generating profits. So we think it's a really good past test of the business. And just looking forward, we can see that it has modest capital requirements and really high returns on incremental invested capital. And it's growing to be more diversified. So it's becoming less risky as it grows. Very quickly, some of the risks that we think about, China slowing down. About 40% of the current business is tied to iron ore. Some things offsetting that, though, the customers that they have are the lowest cost curve producers, so BHP, Rio, etc. They're way down, they're making vast profits today, so the price would have to fall a lot before it really hurt them. And even if it did, those businesses tend to continue to produce tons. So we'd expect to see a lot of Meta's business there be kept around, but also it can be redeployed. The biggest constraint in this business is labor, trying to get people onto site, and lastly, just culture. So very quickly, catalysts. We think there's explosive growth in Meta Canada, Meta Energy in North America, and fixed infrastructure, potential for a re-rate and earnings growth at the same time. We're estimating intrinsic value to be over $4, about a 33% upside, but more importantly, because of its low multiple, we think it has the potential to keep compounding at sort of 30% a year. Comparable to another business here, but in a different industry, similar margins that trades on almost double the multiple. yeah, so that's all I have time. I don't know if we have time for questions, but feel free to hit me up. I love collaborating with folks on this and talk to a few investors about this idea as well.